Look, let us be completely honest with each other right now. Your bank account is being actively raided by the people in charge of the printing press. And if you are still sitting there waiting for some magical government savior to fix the economy, you are the exact target market for financial destruction. The United States Senate just confirmed Kevin Warsh as the new chairman of the Federal Reserve in a brutal wusasi dal sishawufuta ot, which is officially the most divisive partisan confirmation in the entire history of the central bank. Jerome Powell's term has officially slammed shut, and the absolute circus we just witnessed behind the scenes should make you check your portfolio immediately. Donald Trump did not just dislike Jay Powell. He spent years treating him like an absolute verbal punching bag in front of every reporter with a microphone, calling him a moron, a dummy, an imbecile, and a stubborn mule on national television. And the entire reason for that public execution was simple. Trump wanted immediate, aggressive interest rate cuts to juice the economy, pump the stock market, and create a beautiful illusion of prosperity leading up to the critical midterm elections. But Powell dug his heels in because he knew that cutting rates into a structural supply shock would turn the inflation fire into an absolute nuclear meltdown. Trump threatened to fire him. Powell called his bluff, and he managed to limp across the finish line of his term. But now, the regime change is officially here. Trump hand-picked Kevin Warsh, an ultra-wealthy financier with deep personal connections to the Trump family, who is worth an estimated $10 on paper. Let that number sink in for a second. The guy entering the room to tell you about your grocery bills is already sitting on nearly $9 in private asset holdings. And by the time this magnificent public service opportunity is over, his family wealth will easily blast past $10 through systemic connections and elite asset inflation. But here is the absolute catch. Trump did not put Warsh in that chair out of pure admiration. He brought him in to do two specific things: print trillions of dollars on command and force borrowing costs down to the absolute floor. But the real question we need to ask is, how on earth is Chairman Warsh supposed to deliver on those promises? When the macroeconomic reality is completely on fire, let us look at the actual data instead of the political spin. Ever since the pandemic chaos, the Federal Reserve has been desperately chasing a target inflation rate of 5%. That is their ultimate line in the sand. And this is exactly why Jerome Powell became a literal laughing stock, because he stood at that podium 6 years ago and told the entire world that high inflation was just transitory. Apparently, in central bank math, transitory means more than half a decade of your cash losing its value. If you look at the raw chart for Shadow, the government's own rigged consumer price index showed inflation at 5% in February, then it jumped to 5% in March, and in April it absolutely surged to 5%. And remember, these are the heavily manicured, highly understated official numbers designed to keep the public from panicking. The real-world inflation rate hitting your wallet at the grocery store and the gas station is easily double that figure. And with the massive conflict in the Middle East causing severe energy disruptions and sending crude oil prices straight through the roof, this inflation shock is not ending anytime soon. The cost of energy is going to keep climbing, which means the underlying cost of producing and transporting absolutely everything in the real economy is going to get significantly worse. In an environment where inflation is actively accelerating toward 5%, begging for an interest rate cut is complete economic insanity. It is the absolute worst possible time to even utter the words rate cut. So let us step directly into the expensive shoes of Kevin Warsh right now to understand the total trap he just walked into. On one side, the absolute kingmaker who gave you the job, Donald Trump, is demanding that you slash interest rates immediately to fuel the corporate engine, but as an experienced market guy, you know damn well that if you cut rates right now, you will instantly trigger a massive currency devaluation and push inflation into double digits. So what do you actually do if you refuse to cut rates? You completely infuriate a sitting president who has already shown he will unleash federal investigations, criminal probes, and absolute reputational destruction against central bankers who defy him. Meaning you risk your standing, your billion-dollar network, and your elite future. Or do you choose option B? Do you completely capitulate to the White House/interest rates when the economy is already boiling, make your Wall Street billionaire buddies incredibly rich, protect your family assets, and completely sacrifice the purchasing power of the average American household? Those are the literal choices on the table. But let us look at what the actual smart money in the financial markets is betting on right now. If you pull up the CME FedWatch tool, which tracks the exact trillions of dollars being wagered by institutional traders, The market is pricing in a 98% probability that the Federal Reserve will leave interest rates completely unchanged at the upcoming June CTH meeting, keeping the policy rate locked between 0.75% and 0.75%. There is a tiny 0.1% chance that the Fed actually raises rates by 0.1%, and there is an absolute 0.1% chance that Kevin Warsh cuts interest rates in June. So despite all of Trump's public demands and relentless pressure, the institutional bond market does not believe he is getting a single rate cut anytime soon. And things get even more depressing when you look further out on the calendar. For the subsequent meeting on July th, the market is pricing in a massive 0.5% probability that interest rates remain completely stagnant, and the probability of an actual interest rate hike has climbed to 0.5%. Think about that. A 0.5% chance of a rate hike is a highly meaningful probability in macroeconomics. It is a definitive warning sign, and the probability of a rate cut by July remains at absolute zero. In fact, if you follow the institutional trade data all the way to the final meeting in December of 2022, the global bond market is predicting that there will not be a single solitary interest rate cut for the entire calendar year. Not one. Donald Trump might possess the personal discipline to hold his tongue for one single meeting in June if the Fed stands still, but if Kevin Warsh goes the entire year without delivering a single interest rate cut, you can fully expect a historic multi-month presidential temper tantrum on social media that will rock the financial markets to their absolute core. Now, if you want to hear something completely hilarious, let us talk about the concept of money printing. We all know what it is. It is when a bunch of central bankers sit at a computer terminal and create trillions of dollars out of thin air to bail out bankrupt commercial banks and fund bloated government deficits. It is the sole driver of the inflation crisis destroying your lifestyle. But why should the political elite care about inflation when they are the ones holding the keys to the printing press? They get to spend the fresh cash first before prices skyrocket. Well, Kevin Warsh is currently out here attempting to pitch a magnificent piece of fiction. He is telling Congress and the media that he plans to execute a complete regime change, claiming he will do the exact opposite of money printing. He says he is going to aggressively shrink the Federal Reserve's multi-trillion-dollar balance sheet, pulling liquidity out of the system, and to that absolute fairy tale, I say yeah, right. That is exactly like saying the United States government is suddenly going to balance its federal budget, or that crooked politicians are voluntarily going to prison for insider trading and corporate corruption. It is a complete fantasy world. In my professional opinion as a veteran market analyst, Kevin Warsh is flat, outlying to the public. I do not see any mathematical scenario where the Federal Reserve can actively shrink its balance sheet and dump assets, when the interest expenses on the U.S. national debt are skyrocketing to highly uncomfortable catastrophic levels. The 10-year U.S. Treasury yield is currently screaming at 0.5% as of Monday afternoon, and the 10-year Treasury yield is sitting dangerously at 0.5%. This is an absolute disaster for the global bond market. The entire system is suffocating under the weight of high borrowing costs. And I say good luck to Chairman Warsh trying to run a quantitative tightening program in this type of toxic environment. You have to understand the mechanical reality here. If Warsh and the Fed actually try to shrink their balance sheet, it means they have to actively dump hundreds of billions of dollars in U.S. Treasuries into the open market, or let them roll off without buyers, which instantly drives Treasury prices down and forces yields and interest rates even higher. That means mortgage rates for a standard 10-year home loan will skyrocket back past 5%. Credit card interest rates will hit historic highs, auto loans will become completely unaffordable, and the interest expense on small business loans will completely crush local companies. Worse yet, the federal government's own budget will be completely devoured by interest payments on the national debt, meaning that shrinking the balance sheet will cause immediate, severe economic damage, spike interest rates across the board, and completely enrage Donald Trump within 5 minutes of execution. The entire narrative is a total contradiction. The reality is that the Federal Reserve is already quietly injecting billions of dollars a month into the banking plumbing behind closed doors. And it is still not enough to stop the structural cracks from tearing wide open. Now, I know this entire macroeconomic trap is scaring a lot of retail investors half to death. When you look out at the horizon for the remainder of 2022, the absolute consensus is clear. No rate cuts are coming, and there is a very real mathematical possibility of 1 or 2 forced rate hikes to prevent a complete collapse of the US dollar. But here's the common sense question. How on earth can they raise interest rates when the real economy, corporate earnings, and the average consumer are already suffering immense pain? The mainstream media keeps telling you that the Fed will just raise rates a tiny bit from Siwu to Sidernin or Siderarwu to magically cure inflation. Let us be serious for a second. Do you honestly believe that a pathetic little Arshu basis point adjustment is going to suppress a global structural energy crisis and stop prices from soaring? The last time a Federal Reserve chairman actually possessed the spine to destroy a structural inflation crisis, Paul Volcker had to jack interest rates up to an absolute peak of Arscher, not C, Arscher. That is what it actually takes to kill entrenched inflation through monetary policy. But we have already demonstrated using hard math in a separate video why this current government cannot survive interest rates at Shir, let alone Arscher. If rates hit those levels, the interest on the national debt would instantly consume eBay of all federal tax revenue, leading to an immediate sovereign default and a complete collapse of the global financial system. Listen to what I am telling you. The Federal Reserve is completely trapped. They have no escape route left. Every single policy choice, every single road they take, ultimately leads right back to the exact same destination. Turning on the money printing presses and inflating the debt away, it is an absolute mathematical inevitability. There is no other way out of this corner, so instead of losing sleep over what some wealthy politician like Kevin Warsh says at a press conference, you need to focus on what you can actually control. Stop holding massive amounts of melting cash in a low-yield savings account while inflation eats it alive at a year. Stop wasting your hard-earned capital on speculative, volatile garbage coins, thinking you are going to get rich overnight. You need to run your personal finances like an elite business. You need to execute extreme discipline, cut out the luxury status symbols, drive an affordable vehicle, and aggressively funnel your surplus cash into high-quality, liquid productive assets that possess real price discovery. I am talking about establishing a rock-solid foundation in the SP Wudinin through stable ETFs, like VO, or locking in compounding cash flow through dividend growth powerhouses, like SHD. That is how you build an absolute fortress around your family's wealth that can withstand whatever monetary madness the Fed decides to unleash next. Look, the financial system is getting weirder and more volatile by the day, but I am going to be right here in the trenches with you, keeping you updated, stripping away the corporate jargon, and helping you navigate through these absolutely chaotic economic times. Do your portfolio a massive favor. Hit that subscribe button right now, drop a comment below, letting me know if your personal household budget is feeling the squeeze of this inflation. Thank you for the incredible support. I appreciate every single one of you. Have an absolutely beautiful day. Stay disciplined, stay invested. And until next time, take care.